Hello everyone, I'm Chad Smith, one of the managing partners here at Reveille Wealth Management, and I'm joined by my partner Stephen Weitzel, and together we lead the investment committee here at Reveille. So we wanted to come on today and discuss briefly the recent development of the downgrade of the U.S. government credit rating by Fitch, one of the rating agencies, and also discuss how it's similar or maybe also a little different from the same thing that occurred about 12 years ago when another rating agency downgraded the U.S. debt rating. So, Steve, why don't you kind of give us an overview of what's developed?
Apparently this is the season for government downgrades because, as you mentioned, 12 years ago, first week in August, Standard & Poor's comes out and downgrades the U.S. government credit rating from AAA to AA+. And here we are 12 years later, and Fitch does the same thing from AAA to AA+. Outside of that, that's really where the similarities seem to stop, because the market reaction seems to be quite different this time around. We're going to put up some illustrations to demonstrate that for you. So the biggest one would be, 12 years ago when S&P came out and downgraded the U.S. government credit rating, it really caught the market off guard.
Yeah.
And so we saw risk assets sell off pretty violently in the aftermath of that. The S&P 500 was off more than 10% in the week following that downgrade. Compare that to a sell-off in the S&P last week when Fitch did the same of around 2.5%. So not nearly as violent a response. But ironically, 12 years ago, when S&P downgraded the government credit rating, we saw the very instruments that were backed by the U.S. government, Treasury bonds, that they actually rallied in the face of that downgrade. And so we saw Treasury bond prices going up following that and interest rates coming down. Whereas this time around, we've been in an environment where interest rates have been going up and bond prices have been coming down for about 2 years. And even though we saw a little bit of weakness in the stock market last week, there was no safe haven bid in treasuries. They sold off, continued to sell off in the face of this downgrade. So that's a real difference. Similar action for the U.S. dollar. 12 years ago, even though the U.S. government was getting downgraded, the dollar rallied in the face of that. This time, the U.S. dollar has been in a downtrend for the majority of this year, and that downtrend still seems to be in place. So, again, I think the market reaction this time is much more muted, really because the market isn't caught off guard by this. So, the Congressional Budget Office, in their report from the end of June of this year, highlighted the fiscal challenges that our government has, that the interest expenses as a portion of their annual outlays is just becoming more and more. The expectation that annual deficits are going to increase and that the national debt is unlikely to slow down at all. It shouldn't come as a surprise, and really didn't come as a surprise, that we had this downgrade. So ultimately, I think the path of least resistance here for the dollar, as we've talked about, remains lower. That could be part of the fallout of this. And so if we see that further U.S. dollar weakness, perhaps that leads to some more sustained inflation. So let's talk a little bit about what is an investor to do? How are they going to protect themselves in that environment? We live here in the U.S. We're U.S. dollar-based investors. What do we do to protect ourselves against that situation?
Yeah, certainly. Well, so to the extent that this, along with other things going on in the world, lead to a continuation of inflation being elevated for some longer period of time, we need to be mindful that over time, historically, one of the best hedges against inflation has actually been ownership of stocks.
That's right.
And so to the extent that the market environment remains favorable, which at the moment it is, we will stay aligned with that and continue to look for opportunities in the equity market. for that kind of hedge against inflation. But then the other factor being, again, this potential for this development along with other factors leading to dollar weakness that may continue. That's been a recent phenomenon, and that may continue for some period of time in the future. If that does develop, then that may play out in the form of opportunities for other asset classes to appreciate in value, right? So commodities of various types, precious metals, of course, gold and silver, etc., but also other foreign-based currencies, foreign-based assets like equities. And so even though we're, as you mentioned, dollar-centric, we're also responsible for looking for opportunities for clients all around the world.
That's right.
And so we can be mindful of what's happening, but look for opportunities that will present themselves from maybe dollar weakness and find those uptrends that exist around the globe.
That's right. And, that's where we can be thankful that we have our rules-based discipline to try to help guide us through these periods of time. 2023 has not had its shortage of going market concerns. This is just the latest one. But knowing that we have our investment discipline to fall back on to give us confidence of how we need to be invested, keeping us invested in markets that we would need to be invested in, but that we might not otherwise want to be invested in. So we thank you all for joining us here today. Hope you found this discussion helpful. If you have some other thoughts or questions around the downgrade, want to talk more about how it impacts you or what its implications for the market could be, feel free to reach out to your Reveille financial advisor or email us at info@reveillewealth.com. Thank you for joining us, and we'll talk again soon.
Thanks.
Bye-bye.